Let me quickly go live on YouTube. How do I get it to? I am kind of confused how we should have had it. Let me stop the live stream real quick. Okay, 1 second. All right, I think we are now live. Chris, how are you?
Doing great, Yusuf. How are you this Saturday evening?
Doing wonderful. Been busy helping people out, answering questions, and see if we could help more people out today.
That sounds great. Always love helping people out. So let's get started.
Absolutely. Appreciate your time. Thank you very much. And for the people who does not know, this is Tosif with Chris Peden, CPA. We're both based out of Northern Virginia. Our goal is to save as many people taxes legally as possible and see if we could educate you, whether you work with us or not, to at least have some level of education so that next time, next year, wherever you're filing taxes, if you could position yourself as a better position. If you have not watched our previous podcast, make sure to go back and see that as well. We'll link that on the description below. But for now, today, we will be continuing from our previous conversation where in our last conversation, we discussed with Chris about some of the basics of different entity structure. Today, we're going to be talking about a very important topic on that regarding corporate record keeping and bookkeeping. And since Chris has been dealing with taxes for a while now in this area, my first question for you, Chris, is how often do you think that people get into trouble for not having a proper books or records?
Well, that's actually a very layered question too, Sif, and it just goes beyond taxes. I've run into clients who say, yeah, I've got all the backup, but then when they get that letter from the IRS, the IRS will say, well, that's not exactly the backup we were looking for, and we end up trying to go back and reconstruct things, and you don't want that to happen. But I also have other clients that've got everything all lined up and nice in folders. I can't reach it now, but if you get one of those pocket folders that you keep just for every year, you put the documents in there, put them in the file cabinet, and you can just refer back to them. But as far as record keeping with your business, people think, oh, geez, I've got to get set up on QuickBooks and do all this. Well, there's a reason for that. And way back when I was in college last century, then we had this maxim: what gets measured gets managed. So by keeping your books up to date, you're not just doing a little task there that you're supposed to do, check a box and move on. You're actually putting together a form that you can take a look in your profit and loss and your balance sheet that can help you run your business. And I help people decipher that. I put it into what I call normal people talk in my business to say, all right, here's what's happening in your business. We can forecast this out and see where you're going to be. And then we kind of take a look at what changes can be made so that you're actually having the cash from your business that you actually want. So don't look at bookkeeping as a chore. Look at it as a way to help you run your business better and to get more cash at the end of the day.
Awesome.
So that's why it's so important, and not just check the box.
That's a very good, very important point you just brought up. What gets measured gets managed. So I know you have been in the CFO services as well, Chris.
Yep.
One of the things people always, I have come across people that, hey, I'm doing so many sales, so hard work. At the end of the day, why do I not have any cash left for myself? That's where it becomes like you have been having some weird, spooky, unnecessary subscription that you never even use properly.
Right. And you've got to ask us. I get asked all the time, what can I do to cut my tax so I have more cash? I say, no. Think about, if you're going to make a purchase, always ask, how much more revenue will this bring in so that I can have more cash at the end of the day? So if some comes to you with a very flashy marketing plan, stop them and say, all right, for every dollar I spend with you, how much in cash am I going to get?
That's an awesome question. I love it.
Yeah. Stop it. Just ask. So yeah, it looks cool, doing all this stuff with Facebook, but it don't mean a thing if you don't get the bling.
Absolutely. And if you think that you are too overwhelmed to do bookkeeping and not able to do it properly, just outsource it. Here at MTR Groups, we also do bookkeeping. And since we have partnered up with Chris is going to be a great resource to bring in to oversight your entire business and see where the profitability can chime in. So make sure to book a call. Let's see if we could help out. Or even if you're not using us, see if there is a better option for your business so that at the end of the year, you're not scrambling for numbers for both taxes, or even in case of IRS, you're not coming out of a shock, because that's when you're going to make the biggest mistakes and lose out a lot more and end up paying even more.
Yeah,
So
that's why I tell my clients is, look, you're afraid of asking your CPA a question, and if you're afraid of your CPA looking at you like you're stupid and just the eyes over the glass like that, look, if your CPA talks to you like you're stupid, it's time to fire the stupid CPA, because I would rather have you ask me the question than get that notice from the IRS. Let's cover it now. And really, there's nothing you can ask me that I would think that you're stupid. I see, oh, this person's on top of it. They want to make sure everything's there. So it's actually, I I respect you more for asking the question. So ask the question.
that's an awesome aspect to look into it is if your CPA is looking at you as another number, it's probably time to change your CPA. And that's a great perspective, as Chris mentioned, is find someone who sees your business as his business, deals with it like someone's baby. Because at the end of the day, this business that we're dealing with is what's carrying our family as well in the back end. So if we don't treat it like a baby, tomorrow it's not going to be carrying us back in any shape or form. So it's going to be stumbled upon. So it's great that you brought about the records. Let's talk about some of the basic styles or the basic methods that IRS recognizes and wants us. I know there is two major aspects. How many typical ways, Chris, do you think any individual should consider from to incorporate the accounting methods and the recording keeping methods in their business?
Well, a lot of the software programs that are out there, QuickBooks included, you can just take your phone and take a picture of the receipt itself, and then you can attach it to a transaction. And then when the IRS comes knocking, you can actually pull up the receipt and not have it clogging up your records. Now, you probably want to hang on to those. And the IRS publications or guidelines have said, hang on to most things for 3 years. There are going to be a couple other things that you got to hold on for longer. So 3 years, I say, you know what, hold on to them for 4, just in case something happens computer-wise that somebody breaks QuickBooks finally. Somehow that happens. So, but you have the paper. But otherwise, after that, you don't really need to worry about it. But if you like buy a piece of property or something like that, keep it until a couple of years after you sell the property, just in case there are any questions that come back. And it was funny. I was looking at the regs regarding period of limitations that apply to income tax return, and one of them is keep records indefinitely if you file a fraudulent return. Oh yeah, I'm going to hold on to this forever because I know I filed a fraudulent return. No, it doesn't happen. If you work with Tusif and I, we're going to make sure that you're not filing something that's fraudulent.
Yeah.
We're going to ask the questions, but I'd say hold on to 4 years. And then also there's electronic methods, and they give you a electronic copy. I know that I was working with a client, and IRS now is getting into the 21st century, and you can actually upload documents there. So if they're accepting an electronic copy on their end, you should be able to keep one on your end. So
Absolutely.
electronic copies are just fine, and it's a matter of who can give you the best bang for your buck as far as keeping those receipts electronically for you and storing them.
Absolutely. And what I personally am doing and also having my clients do is upload them on a Google Drive. Take a picture, upload them on a Google Drive. If you don't want to pay for QuickBooks, you're like, you know what, QuickBooks is not worth my buck. Google Drive is free. You get 15 gigs. You can store a whole lot of receipts in 15 gigs, even just for free. And if you think that that's not enough, open up another Google account. That's easy. One for your business, one your personal. So
now, I'm going to caution you. Hold on there a second, too. One thing I would caution you is make sure that you have some security around your systems here.
yes,
That no one can get into it. I use a secure portal with my clients, and I have clients all over the United States, and we have a secure portal. I tell them, do not send me anything over email because, you know, as a friend of mine says, the Bulgarians are watching your email.
that's a good point you brought up is you save things on your drive, but you don't transmit because typically that's when things are getting lost. So whenever you make sure whenever you're transmitting from your personal drive, your business drive to your CPA or whoever you're dealing with, make sure you guys are using a secure portal. And most of the modern day softwares typically come with a secure portal that you can upload, which meets all of the IRS security guidelines. So if you're working with me or Chris, I know it's easy for someone to just come in and just say that, hey, you know what, just take my stuff. So I always recommend either upload me on my secure portal or don't send me. Or sometimes in the worst case, you're so lazy, give me some level of access to your drive. I don't want that to be transmitted to anything.
Yep.
So that keeps us the issue of transmittal and that IR security protocol as well. So now let's get into the two major aspects of accounting methods. So I know last time we spoke about different entity structures, and IRS allows us to use different accounting methods, whether it's cash, accrual, or even combined hybrid or something else. Help us understand some of those, Chris. Is there only two, more than two? What are the traditional ways?
Well, the most common is going to be if you're a business, say an LLC, a sole prop. Most of the time, you're going to be a cash-based business, and what that means is you don't recognize a sale until you get the cash in hand.
Yeah.
So, and then, but an accrual method means that you recognize the transaction when it happens. So, difference would be is if I billed Tusif for $500 for his services, for my services. So if I'm on accrual, I'd recognize it right away. But maybe Tusif is having some, his wife is having him redo the kitchen, so his capital is all tied up in there. He can't quite do it, so he doesn't pay me for 2 months. So what will happen is I don't recognize that cash until I have it in hand. Now the same thing goes for paying out. So if you're in accrual, it's when the transaction occurs. So if you shake the person's hand and say, all right, we got a deal, you recognize it. But if you're on a cash basis, it's when you write the check or you put it on your credit card. And that's when it's going to happen. And most of the time, you're going to be working with the cash method on your with your tax return. Now, the great thing about a lot of these softwares, the QuickBooks, Mint, and the like, although Mint's not being used for business, is that you can flip between the two, so that you can give your accountant a cash basis financial statement, but you can use the accrual for running your business. So it's just really a matter of flipping between the two.
So I'm gonna dumb it down and ask some dumb questions. So that
No such thing. We just went over that. So no such thing. You asked the question, man.
Yes. So what you're saying is we can two methods when we actually understand when we recognize the transaction. That's pretty much it. Either when the cash is received or when the transaction or the service is received. Now, first question: can someone flip in between these systems 1 year to another year?
No, you can't. So once you sign up with the IRS, they're going to ask you what method are you using. You'll check a box. And I've actually have never switched someone between a different accounting method, but I've seen the processes you need to do it, and you pretty much take a machete, cut off your right arm, and send it to them is pretty much the process for that. It's very hard to do that. It's a long, complicated form, and it needs to go through review of the IRS. So think very carefully before you set up your company, and maybe just stick with one method. There's not too many companies I would know of that have switched midway through that them do that. But really, given the technology that we have right now, there's no reason why you couldn't just stick with one for your tax reporting and then the other for running your business.
So when you said one for tax reporting, one for running your business, how does that work out?
Well, what I'm saying is that you can report for cash, for tax, and then accrual for your business. And if you're using a software like QuickBooks, you'll be able to, if you pull up a report in QuickBooks, like your profit and loss, you can actually go in there and say, I want to see this by the accrual method or the cash method, and it will flip it for you. So it does the work for you.
So can I do a mixture of both as hybrid?
You can do, and it's usually a industry specific thing that you would do it hybrid. 99% of the companies are just going to do one or the other. It's going to be special circumstances that you need to sit down with your accountant and say, all right, here's why we're probably going to need to do it. And again, it may be industry specific, and I'm not really thinking of any particular industries that would apply to right now. But talk to your CPA about, say, look, here's the business I'm in. What accounting method do I use if there's a special one to use? So that's a conversation to have with your CPA to see what works better for you when you're reporting your taxes. But once you choose one, you can't switch to the other without going through a lot of rigmarole with the IRS.
Awesome. Yeah, because each individual has its own benefits and tax benefits. But the moment you try to take the better of both, IRS is like, hey, you might as well be doing something shady and putting something in the loop. So
Exactly.
that's why, as Chris mentioned, have consistency with your books. Even if you're making mistakes, make consistent mistakes. So that if someone were to go back and fix it, he could fix one thing and the rest of the things falls through.
Absolutely.
So that's a great insight. And in terms of one or the other, what are the benefits one over the other? Give us some examples.
Well, what's going to happen with the cash method is that you don't have to recognize something until it's you actually get the cash. And the benefit would be is it's a kind of a tax savings move. Is that if you're on a cash basis and you bill people at end of December, but you don't receive the cash until the following year, you're not going to report that cash on your tax return until the following year. So you get a benefit there. But the other thing is that when I was talking about expenses, you report that when you write the check and send it out, or when you put the credit card in. You could do that up to 11:59 p.m. on December 31st, and you will recognize the expense right then and there. So when you're making end of the year, you want to start buying some supplies and lowering that taxes. You have until 11:59, or when your spouse drags you out to go to the New Year's Eve party. So that's going to be the big difference there. But with the accrual method, it's going to be you'll be able to recognize things sooner. So when you're doing reports for investors or you're trying to get a loan, you'll be able to say, all right, well, here's where the money, here's the billings that I have, so that or the bank can see that, hey, yeah, this guy is making sales. Whether or not you collect on them is an entirely different matter. But when you're trying to get a loan, what have you, that's what they're going to look at. So it allows them to see that, yeah, you do have billings coming in. So yes, you can qualify for this loan.
That's awesome. Couple of the things that actually happened with myself when I was dealing with real estate transactions. One of the deals that we've finished was towards the November, December area, but the funds was received in January. My LLC was a cash method, so it did not recognize the income up until next fiscal year where we had more deductions. So if anyone who is planning on, this is the last 2 months, this is a great advice, especially at this time, is if you're a service-based, we're trying to boost our marketing, trying to boost on maybe product, maybe supplies, make sure to order them, even if the supply does not reach before the end of new year. Just because you ordered, it is the cash method.
Yep.
And even if you did the sale, that's awesome. You can now actually put in more offers for your customers that, hey, we are going to allow you to pay in 30 days. Give 30 days terms. That's a great thing. You're still going to get it, but just because you're receiving it in about a week or two later, you're saving on taxes if you're using cash method. Yeah. And same thing with the accrual method. If you're making a big purchase, like a machine or a big course even, or a big CRM, $15,000, a lot of courses, masterminds, go join it. Even if you're not paid in full, make them in credit card purchase. If you're using accrual, even though it's set, is you're going to be paying $500, but you can actually write that entire 15,000 this year. But make sure to understand that that 15,000, whatever you're going to be paying next year, is not going to be recognized in next year. So sit down with your CPA and understand the planning when it is the best for you to take the deduction. Awesome.
And
So-
before we go any further, too, I also want to throw out there is if you have not set up a self-employed retirement plan before so far, make sure you do one before the end of the year so that you can make contributions to it when the tax return is done in April and October, what have you, because you have certain plans that you can, as long as they're set up, you can make contributions to them for the prior year as long as you make them before you file your return. So get the self-employed retirement plan set up.
Awesome. That's great. So if you are doing the self-employment tax, and also for the LLC sole prop, a great opportunity, especially this year, is you could max out your self-employment retirement plans up to $120,000, close to around that amount. So make sure to take that tax deduction. And if you are retiring sometime later, you can actually take that at a lower tax level if you're actually retiring by itself. So that's a great suggestion. I appreciate that, Chris.
Absolutely.
So,
we're here to save people money. Let's do it.
Absolutely. $120,000 is a lot, people.
Yes, it
And
is.
even if you're a single guy, it's almost $60,000 to $66,000. Make sure to check with the actual latest updates whenever you're doing it, and if you can, just max fund it. And the fact that we spoke about last conversation, that sole props gives the easiest benefit to move money around, or LLCs, unlike S corp or C corp, where you have to do, through most of the cases, take a salary out, go through a payroll, where you're not having the same issue in LLC. So wherever you are at, make sure to take benefits of the entity structures that you are having. Sit down with your CPA, let's have a conversation. Before I get to much nitty-gritties, let me ask you this, Chris.
Yep.
Is there any requirements based on the entity structure that, hey, this entity has to use cash-based, this entity has to use accrual-based? I heard something about C corps typically have to use accrual unless they have to use cash for some other reason.
Yeah, I'm going to agree that that's most of everyone is going to be able to use the cash, but the C corporation is the accrual. However, if you own inventory, then you're going to be required to use the accrual method, because that's just kind of the rule, is that if you are carrying inventory, you want to use the accrual method, because that's when you would record inventory on your balance sheet and the cost of goods sold and what have you, and what we have to do. There are some caveats to that can be discussed maybe in a later episode, but for the most part, everyone's going to be cash except for C corp. And if you carry inventory, that's when you're also going to want to think about using the accrual method as well.
Awesome. So people who have elements like general contractor or doing drop shipping in Amazon FBA or online retail store, or any kind of retails, whenever you're doing, even if you're not having a C corp, if you ended up structuring it as an S corp or an LLC, just because of the ease, make sure to reconsider, instead of cash method, try to use accrual method as indicated and guided by the IRS. Now let's get into the elements of the books. You spoke a few nice words like P&L, profit and loss statements, balance sheet, general ledger. What are the typical components of a book in a business?
Well, you got two main reports that you're going to be looking at. Is you got your balance sheet and your profit and loss. And the way to describe this was described to me way back last century when I was starting in accounting. And the balance sheet is a photograph, the P&L is a movie, because a balance sheet shows that this is what you own at this point in time, whereas the profit and loss is going to be growing month after month. So it's always going to be changing. So when you look at a profit and loss, it'll say at the top for the period ended such and such. So you're going to be looking at all that as you move along during the year. So the basic components of for each of them, I could list them out here, but really for a profit and loss, it's sales minus expenses equals your profit or loss. That's it. There are different components within there. With a balance sheet, it's going to be you have your assets as everything that you own that you use to bring in sales cash for your business. You have your liabilities, which is what you owe other people that you borrowed so that you could run your business. And equity is basically the accounting equation is assets equals assets or assets. Yeah.
Assets minus liability is the equity.
Owner's equity. Yes, it's late Saturday night. Can you tell? So what it is that people say, what is owner's equity? I said, all right, if you were to close up shop and you wanted to go to Tahiti, owner's equity tells you how much cash you could have to go to Tahiti. That's pretty much the best way to describe it. Assets are the things you own that you use to run the business. Liabilities are things that you've taken on to run your business. And then equity is what you can have if you were to shut the doors right now and walk away from the business. So those are the basic components of both of those financial statements. And of course, you have your statement of cash flow says this is where the money has gone. And it's a bit more complicated, but it really is a good thing to look at when you're like, okay, well, what am I spending my money on? It's in using conjunction with the profit and loss. Actually, the profit and loss and balance sheet together, you use those to come up with the statement of cash flows. And I remember years ago, all I did was I had made up a spreadsheet, and the changes in the balance sheet accounts, they went on that cash flow statement. And at the end of the day, we ended up with a cash flow statement. So it's really something to look at if you don't have it to say, all right, what am I spending my cash on? At the end of the day, cash is king, and you want to have more coming into your business.
Absolutely. And as a matter of fact, that's how you can figure out your business KPIs and where your money is also actually going and what's working for your business. Like if there is a marketing campaign you're doing and you're not getting a lot of leads from that, you probably need to reconsider that marketing campaign. Same thing in your business activities in terms of finances. Profit and loss does give you the aspect of what's working in your business. On an accounting perspective, where are you losing money into? The more the difference you're going to be able to make, the more money you're going to be able to keep. That's the fundamental of any business.
Yes, indeed.
And as a matter of fact, a lot of the things does change if you are just, especially in the real estate world, when you're actually getting refinance cash a lot, which is not going to be going into the income statement, the tax income statement, but it is going to be going to the business cash statement, because on the tax statement, it's going to go into the basis. So tell us a little bit about that and how in conjunction with the balance sheet and P&L, because I know a lot of my viewers are real estate investors. How would that work out?
Well, when you're buying properties and you own these as a real estate investor, it's going to show up on your balance sheet as an asset. And then what's going to happen with that asset, we'll be able to spread the cost of that over a certain period of time. So you will get a tax benefit from that. So, and then the cash that you get in for the rental of those, or you're flipping it, is going to go onto your profit and loss. So you bought a piece of property for so much, you sold it for this much, hopefully, that you're making a profit on it, and other little nibs and nabs that Tusif and I will walk you through to make sure that you're getting that you're saving money on taxes, but still making money on the deal.
Yeah.
So that's what's going to happen, is that when you invest, that's going to go on your balance sheet as an asset in your business that you're using to make money. And then if you're paying a note, that's going to be a liability that's going to show up on your balance sheet. But you start collecting rent, and then you have to pay money to do. Somebody punches a hole in the wall, you got to fix it. That's going to be on your profit and loss, or pay someone to manage your property. That's going on a profit and loss. So every activity that you're doing with your rental properties or your properties in general is going to flow to one of those statements.
Awesome. So just to give an example for the viewers, say for example, someone bought a house with $500,000. It goes first to the asset in the assets statement as $500,000. Now, say for example, he put 20% down. Now, on the liability, that goes for $400,000 if it is a 20% down. Yep. And on the equity statement, it becomes $100,000 because that is how much you put in. But the rent you're going to collect is going to go to the element of income. And when you're going to be
loss, yes.
Yeah, on the profit and loss statement, and the amount of expenses like fixing things up, insurance, taxes, those are going to go to the expense side. And a unique question comes up is, if I am saving money for future repairs, can I write those off in this year and not touch the money?
Well, it's good that you're doing that, but it's unless you have a transaction itself that you're spending the money. No, you're not going to be able to write that. You could set up a fund on your balance sheet that's a kind of savings account, what have you. Or you may want to talk to a financial advisor and have them say, look, I'm setting this money aside for this purpose. I will need to get to it maybe at this time period. What investment vehicle can I put this in so I'm earning a little bit of cash on it while still having it available in case somebody puts a hole in a wall, tears a door off, the hinges, what have you. And you would be able to still have that as an asset in there. But until you actually are making a payment on something, no. I get a lot of questions from my clients that are basically, they have a W-2 and they've got a mortgage. And they're like, well, why can't I save any more money? Well, because you haven't done anything.
Yes.
So if you want a tax break, you actually have to do something. There not anything that is there's no obscure language in the tax code that allows you to write it off because you're pretty. So, like Tusif. So,
oh man, in that case, Chris, you would not be paying any taxes.
But so yeah, no, you're not going to be able to write that off. But it is a good idea to put it aside. But where you're putting it, talk to your financial advisor, because they may have some ideas about where it can go that would serve
Awesome.
you and your company the better.
That's a great point, because in real estate world, it's not that if there's going to be repair, it's just when there's going to be a repair. And the fact that IRS does not allow us to take that deduction, that's a great option that you brought up, is put things into investment accounts that you can access the money, either cash out or take a loan against it. That way, when you're doing really that, you can actually spend that, because at that time it is going to be an expense, but your money is actually growing in a way that might even be tax-free. In some of the investment vehicles are a lot of the times are tax-free, like a Roth IRA, or even life insurance. If you're having a proper say for example, whole life insurance, you can actually take a loan against it, but all the growth in life insurance is pretty much tax-free.
Yep.
So as Chris said, talk to your financial advisor, or even we can actually even guide you up to a certain extent that, hey, you might, even both me and Chris are licensed insurance agents in Virginia. So we could even probably think of some of basic ones, but as you grow, we would definitely recommend talking to a financial advisor as well. The next question I have is, where does the depreciation go in terms of all of those six elements that we spoke about?
Well, first of all, depreciation is going to go on your profit and loss as a deduction.
Awesome.
So it's an expense there. But also what's going to happen is that we have something called accumulated depreciation. So you bought a house, would you say $200,000? That's going to be over 27 and a half years. So 27 and a half years worth of depreciation in the first year, whatever that number is. It's Saturday night. We're not doing any calculations. But the first year is going to go against that. So when you sit down and you'll be able to say, all right, the net amount of that asset is going to be the 200 less the 127.5 of it. So you'll have a net value of the property. So when you get ready to sell it, you will know, all right, well, this is the amount of gain I'll have, because you have to take what you paid for it, less any depreciation taken, and any kind of capital gains or what have you are going to be calculated that way. So the depreciation is going to go on your profit and loss or income statement, and will go on your balance sheet as a reduction in the value of the asset itself, the house that you bought.
Awesome. So even though the asset itself is going to be that amount, each year you're going to be able to lower that value amount by the depreciation amount, and that's how much it's going to be equity. But that's not going to be real equity, because you probably are going to be having appreciation. You're going to have the difference of actual appreciation, and after that value that you have already paid mortgage off, that's going to be the difference that you can probably get your equity tapped into. That's a great point you brought up.
Yep. Don't record appreciation. Wait till you sell it. Okay.
Yes.
That's going to be a huge headache, and your CPA will look at you over their glasses going, no, you're a fool.
Yeah. I mean, up until that, don't record appreciation in your books.
Yeah.
It's gonna be nuts for not only yourself, but also even if there's investors coming up in some cases. Keep the appreciation separate. Have them some sort of calculation comp sheet, not in your personal balance sheet. It's gonna mess up the entire record keeping elements, and also in some cases tax returns, because now you're gonna be in a point, if you did not sell it, that appreciation is not recognized.
Yep.
And if that's not the case, if you're mixing things up, your CPA might get into a wrong box. And you're going to be paying more taxes as recapture tax than you should have been paying in the first place.
Yes, indeed.
So that's an interesting point. And I actually remembered another question asked to me quite some time ago is, if I did not take any depreciation, can I retake it now? So say, for example, someone has been paying mortgage for 15 years, all of a sudden they realize that, yo, it has been a rental for me, but I did not claim depreciation up until so many years. What would they do?
There is a specific form that you actually can fill out. I did this for a client a little while ago. And there is a time limit that, if I remember correctly, that you can get some depreciation back for that. But it does allow you to kind of catch up on the depreciation. And that's a good point, Joseph. I'm glad you brought that up, because I did have a conversation a number of years ago with a gentleman who thought that because he actually didn't take depreciation on his property, and thought that he was going to have a loss on his property. But what the IRS rules say is that it's depreciation that you could have taken, not whether you took it or not. So they're going to get you with that trap. And he ended up having to owe money, and he couldn't believe that he actually had to pay taxes on it, because he didn't take into account the depreciation that actually occurred. Your house is going to depreciate. Your car is going to depreciate, whether you believe it or not. There is not a structure or piece of equipment on this earth that does not depreciate.
That's a great thing. So for all our viewers, make sure to realize that if you can depreciate, do depreciate, because at the end of the day, even if you did not take it, there's a couple of places IRS law says if you were allowed to take it. That is such a big headache. It's going to be not only in this case, even if you own stocks. If you are issued stocks with option to take cash or option to take a stock, you will have to recognize that as your income at that year. So if you're taking stocks as a corporation or any kind of asset that can be classified as capital assets, make sure to take depreciation against it. And if you don't want to pay tax, make sure to structure it in a way that's going to have, you're not allowed to take cash outside of it. What it's going to do is the moment you're allowed, you have the option to take cash, you are recognizing that income. So that's a great point you brought up. So if you did not file your depreciation for so many times, do reach out to us. We can, if you're still within that time limit, we could probably recapture that. Of course, you're going to be paying recapture tax when you sell it, but even if you did not claim it, you're still going to be paying that 25% for nothing. At least you better claim it and then pay taxes as opposed to not claiming it and not doing anything.
Yeah, it's a benefit that if you've got it, take it. My dad says there's no such thing as free money, and if or extra money. If you've got extra money, give it to me. So if anyone's out there thinking they have extra money, I'll take it.
All of us will take it. We'll split it with you.
Yes, indeed.
So that's a great point. Now, moving on to one of the questions that Victor asked, a very good friend of mine, super smart guy. I think he has a PhD in pharmacy, if I remember correct. I met with him quite some time ago. Victor asked an interesting question from our previous podcast. Can you get a business account without an EIN? Can you get an EIN as a sole proprietor?
Yes, you can.
So, Victor, you can't do an EIN. You just have to apply with the IRS.
Yes.
But you need to understand that as a sole proprietor, you being a sole proprietor is something that you're putting a social out. So we always recommend is if you want to be a sole proprietor, just put an LLC.
Absolutely.
Even if it is in the cheapest state, just do an LLC. If a flow-through entity as an LLC is going to be always taxed as a sole proprietor in the first place, but what it's going to do is it's just going to give an extra layer. So think about it. As someone asked this question, what's the difference between entities? I gave him an analogy. Think about it on a windy, cold day. So you're half naked. You're going through the street. Now, is that better, or you put on a t-shirt is better? So a t-shirt is better than being half naked. Then okay, so that t-shirt is your LLC. Then you put a sweatshirt on it. That becomes a partnership or an S corp. Then you put a jacket on yourself. That's called a C corp. So in terms of tax separation, if that wind is the money that is being taken away from you, this tax separation is the entity's layers that you bring up. Sometimes you can actually even layer one above another, but that's going to be real strategic tax planning. And you can essentially leverage different states' code law. And if you have operations in multiple states, you can essentially leverage those elements from multiple states' laws and structure things in a way that's going to be most beneficial to yourself. So I hope that answered your question, Victor.
Victor, here's the thing. You said, Tusif, you said he was a PhD in the pharmacy.
I believe
here's the thing. If you decide to go into it and you go and start your own pharmacy, you're going to probably want an LLC, because what it does is it separates you personally from the business. So if someone ends up getting sick because something happened with the pills, they can only go after your business. They can't go after your personal assets. So if you're thinking about it, go with the LLC. As Tusif said, put the T-shirt on to make sure that you're covered.
Absolutely. The next question I had for you is, when it comes down to books, as we have been having the conversation of books, there can be in some situation that, or not all of the numbers are going to go to the tax codes, tax returns. So there's going to be some of them important for the business, some of them important for the tax returns. Of course, it's going to depend on how much debt and how you're leveraging debt. Tell us a little bit about those, how someone might be able to use them or even leverage them.
Well, of course, there's going to be, as you said, some numbers that are going to be on the books that they can't put on to their tax return. I mean, the one that pops in my mind is fines and penalties. You can't deduct those, and I would reference Al Capone with that, because yeah, he did some illegal stuff and he got caught, he got fined. Well, we're not going to give people a tax break for breaking the law. Although if you make, I think we might have talked about this in the other podcast, or Tuesday I had a conversation about this. If you have ill-gotten gains from any activities, you need to report that income. I don't know how you would get out of it. But there are also going to be other things that maybe won't be deductible. Like for the past couple of years, meals have been deductible for 100% of the time, but then now they're going back to 50%. And the reason they made it 100% is because of COVID, the restaurants got shut down. So the IRS, when Congress wanted to do something to help restaurant owners stay in business, so they made, okay, so these meals are going to be 100% deductible. If you come in, you talk about business, and you have a meal with somebody, we're going to make that 100% deductible. But now that the COVID thing is over, knock on wood, what have you, that it's going to go back down to 50%. So the thing about it is, people say, well, there's not much tax benefit to that. Well, okay, that's fine, but you're not just doing this for the taxes, you're doing this to build your business. Stop and think about it this way. If you were to have the opportunity to pay $5,000 to have lunch with Warren Buffett, but you couldn't write it off, would you pay that money?
Yes,
Absolutely.
I would, because
Absolutely.
that has a business benefit.
That has a business benefit. And then when I get asked, like I pointed out, the self-employed retirement plans, I have clients come to me all the time. Well, I'm thinking about buying a car for my dog walking business. I'm going to get a Tesla. Can I write that off? Why? Because you're not going to get a business benefit by going around in a Tesla. You're better off using that cash for something that builds your business, maybe an advertising campaign, the self-employed retirement plan. So instead of sitting there thinking, well, I'm not going to get a tax benefit out of this, why? You'll get a business benefit, and you build your business, you can earn more money, the taxes won't be as bad, and you can pay your accountant more. So you have all that. So that's kind of the way to look at those things.
That's an awesome thing. And interestingly, IRS talks about something that is normal in that industry. As you just brought up, someone who is walking dogs, it's not normal for them to walk them in a Tesla. So they have a very interesting word, ordinary and necessary. So as long as things are ordinary and necessary, you can deduct those.
Yes.
And make sure that, of course, you are doing those ordinary and necessary. Make sure don't make that ordinary into an extraordinary expense in a way that, hey, okay, I probably need scissors for my dog grooming business, but I'm probably not going to order 100,000 pieces of scissors.
Mm-hmm.
So that's when it's going to become not very ordinary, because you're probably going to be doing something else.
Exactly. And I work with a lot of salons, and some of those scissors are a lot more expensive than the ones you find down at Walmart. They're a couple $100 each. So it really depends on the industry.
Absolutely. And an interesting thing for the you just brought up the meals. So what happens if I spend so say for example, I booked a call with Warren Buffett in wherever he stays, I think in Utah or somewhere. And I'm
Nebraska,
from
but yeah, okay.
Nebraska. Okay. I fly from here to Nebraska. So will I be able to deduct 100% of my plane cost or my stay cost at hotel, those kind of stuff?
You have to have a business reason for it. I was at a conference a couple of years ago, and someone said, "Yeah, this person took their entire team over to Hawaii for this educational event. The event was one day, and then the rest of the time they could be on the beach, so they could write that off." And he looks at me because I was the only CPA in the room and says, "You can do that, right?" I says, "No, there's caveats.
Uh-huh.
The business portion of the trip is deductible, so you want to just make sure if you have to prorate it." But if you're just flying out to see Mr. Buffett and then flying back, the whole trip is just related to building your business. Yes, that is deductible.
Okay, so that let me ask you this then. So say for example, we both I realized that he went to Hawaii. So I also see that I can go to Hawaii and spend 1.5, 2 hours with him, because
Yep.
if I go more than that, it's going to be breaking my banks.
Yep.
So if I spend 2 hours with him, can I and maybe rest 4 hours, chill out on the beach? Is that going to be a business trip? Because I actually did business activity and I also did chilling out activity. So how would that be put into the books?
Well, we'd have to take a look at that. I would think that the entire trip could be, because we're talking about something that happened in the course of a day. So we're not going to mince it to the point where we're counting minutes. But the point of the day was to get out there to see Warren Buffett. And if you're spending maybe an hour, a couple hours at the beach, what have you, you were there to meet with Mr. Buffett. So, but if you had days where you're just on the beach, yeah, then we're going to divide it up and say prorate it to say, all right, well, this is the amount that is going to be deductible for the taxes.
Awesome. And if someone, say for example, I had another doctor based out of Maryland, he was planning on buying properties in Florida because he wants to take his family on vacation in Florida. So he was doing a similar thing. But what I suggested that, hey, if you, as long as you spend more than half of a day, like 4 hours or so, in something that is business activity, whether managing the clients, managing the management company as well, that entire thing becomes business trip. And you can essentially go on a family trip while managing your business and still deduct the stuff. And an interesting thing that does come up here is using the benefit points or cashback points in your books. So I will have you speak of it, then I'll probably share a couple of my experiences.
Yeah, now I've had that. If it's related to a business, I've actually included those in the other income because it's something that you had earned. So that's what I have done just to be on the safe side. So I'd like to hear your experience too, so.
So what I have been having is, as much as I read, understood the tax laws, is those cashbacks are not really income.
Ah,
So, okay, so you are spending. What I suggest my clients is when you go on a business trip, spend from your credit card.
yeah,
If it accumulates, use that for solely personal purposes, because solely personal purposes you cannot deduct anyways.
yep,
But whatever the expense is there, because since you already used up the points, that's no more actually an income, unless what you did, they're doing that is actually claiming that as other income and then deducting it.
yep,
So what I have been doing and suggesting my clients is that, hey, whenever you're doing anything business, spend through your account.
yep,
And the cashback kickbacks are typically not income. So you just use this for personal. It's probably not going to be a lot unless you're using miles card of Amex, miles card, those kind of stuff.
Right.
But you need to understand that if it is, that's my perspective so far based on the code, but if it is something of benefit, instant benefit for some action, like you get a bank fee off to open a bank account and put a certain amount of deposits, that's actually going to be considered as income.
Yep.
So
I
that's
think
not
that was the case that I ran into. Yeah.
because that's not actually a cashback, but it is actually a deduction of fee. So whenever it becomes deduction of fee, that is an income deduction or reduction of your loans. That is an income. So whenever, if there is a bankruptcy process, you have your books. On your books, if the judge forgives your certain amount of debt, that amount is actually an income.
Mm-hmm.
So
It
that is something that we need to be really cognizant of, especially when we are doing those books and cleaning those up. Awesome. I know we're almost at towards the last few minutes. Any last ending comments, suggestions for people on the books?
What I would say is, again, don't be afraid of your CPA. It's ask them whatever questions that pop up. And I told Tusif the story. I went in to speak at the local high school to the cosmetology class and said, ladies, this may be the only time you're going to have a CPA in front of you. You can ask him questions without being charged for it. The young lady raised her hand and said, if I got a dog for the salon, could I write that off? So I get those kind of questions all the time, and I was happy to answer it. No, you can't, because here in Virginia, that's against the Board of Health, and they would shut her down. So again, illegal activities you can't write off. But ask the question, because I would rather have you ask it and we take care of it now than down the road you get a letter from the IRS saying we're disallowing this. So make sure that you have a good relationship with your CPA, and they will talk to you and make sure that you're on the straight and narrow.
Absolutely. And one thing I would love to conclude with is, remember, books are things that translate your message. So you would rather translate those messages with IRS rather than trying to explain it with your mouth.
Mm-hmm.
And those books are going to have much more validity in case of an audit, or even in case of filing taxes, because if you just go to your CPA and say that, hey, deduct this much because I did such thing, and you're not giving them any kind of record, in some cases they may, because in some cases all they need to do is do their due diligence up to you. But if something happens, they're not on the hook because they already filed things and gone. On his side, he's going to say that, hey, we did the due diligence, that this is ordinary necessary for you, so we wrote it off. But the moment IRS comes in, they're not going to take your word for it granted.
Yep.
They are going to try to pull things off, and IRS has invested $80 billion to come after small businesses. So let's not keep shady books and end up having those 80 billions to be recouped from your business. With that, I appreciate your time, Chris. I appreciate the fact that you are giving us so much value, even in these times. And I really thank you. With that, thank you very much. And that would be all for tonight. Everyone have a wonderful one. And if you have further questions, we'll be more than happy to answer. Thank you very much.
Good night, everyone. Have a great week.
You too. Bye.